Okay, so you want to own a logistics company. Buy some trucks, hire some drivers, sign a few shipping contracts, watch the freight move, and the money follow it. That's the pitch. That's the fantasy behind every own your own trucking business ad you've ever scrolled past. A stack of trailers in a parking lot. A guy in a polo shirt telling you this is how regular people become millionaires. Here's the strange part. The people actually making money in logistics right now own almost none of that. No trucks, no warehouses, no drivers on payroll, just a login, a spreadsheet, and a phone, and they're pulling in margins the guy who bought the trucks can only dream about. Meanwhile, the guy who did buy the trucks, the one who looks like he owns the real business, is often losing money on every single load and doesn't fully understand why until the bank calls. Because logistics isn't really the business of moving things. It's the business of knowing where the empty space is before anyone else does. And once you understand that one idea, everything about who gets rich in this industry and who quietly goes bankrupt owning the assets that look the most impressive starts to make sense. There are really only 3 layers to this industry once you strip away the branding. There's the physical layer, the trucks, the warehouses, the drivers, which is expensive, exhausting, and barely profitable most years. There's the information layer, the brokers and platforms who never touch a box but capture the spread between what a shipper pays and what a carrier accepts. And there's the real estate layer underneath both of them, quietly collecting rent on the ground the entire operation sits on. Almost every dollar you've ever paid for shipping got split between those 3 layers, and almost none of it went to the truck. Let's start with the version of this business that looks the least like a business at all. A freight broker doesn't own a single truck. What they own is a relationship on both ends, a shipper who has a load that needs to move, and a trucking company with a truck that would otherwise be driving home empty. The broker's entire job is to sit in that gap and charge for closing it. Here's how the math actually works. A shipper needs a truckload moved from Dallas to Atlanta. The broker quotes the shipper $2,000. Then the broker goes and finds a carrier willing to run that exact same load for $1,700. The difference, $300, is pure margin, and the broker never touched a single box, never filled a tank of diesel, never sat behind a wheel for 11 hours. Do that once, and it's a rounding error. Do it across 3 million shipments a year, which is roughly what C.H. Robinson's AI systems now process. And you're looking at a company that pulled in over $16 billion in revenue in 2025 with adjusted operating margins north of 30% on its core North American freight brokerage business. Genuinely rational when you think about it. They're not paid to drive. They're paid to know. But here's the part that breaks people's brains when they first hear it. That spread isn't fixed. It's not a published fee schedule sitting on a website somewhere the way an airline publishes ticket prices. It's whatever the broker can get away with charging the shipper while paying the carrier as little as possible to still take the load, and federal transparency disputes have surfaced individual loads where the broker's margin hit 44%, while the trucking company that actually burned the fuel and drove the miles saw almost none of it. The broker isn't in the freight business. The broker is in the information business, and the freight is just the product they're arbitraging. 3 things decide how big that spread gets to be. How many other carriers know about the same load? The fewer that do, the more room the broker has to negotiate the price down. How urgently the shipper needs it moved. A load that has to leave today gets quoted differently than one that can wait a week. And how much data the broker is sitting on about that specific lane. Historical rates, seasonal patterns, which carriers are chronically short on freight in that region. None of that requires a truck. All of it requires a database. So why doesn't every trucking company just cut out the middleman and deal with shippers directly? Because information is expensive to build and cheap to copy the moment someone else has already built it. A small carrier finds out which lanes are underpriced today. The broker with the data platform already knew it yesterday. And by the time the carrier catches up, the broker has moved 3 steps ahead to the next mispriced lane on the map. The broker isn't smarter than the carrier. The broker just sees the market first. And seeing it first is worth more than owning the truck that eventually drives it. Now here's a piece almost nobody pictures when they imagine a logistics company. Because before a single truck moves, that freight usually has to sit somewhere first. And the person who owns that somewhere might be the quietest winner in this entire industry. Picture the warehouse. Not glamorous. A concrete box next to a highway on ramp, filled with pallets, forklifts beeping in reverse. Nobody dreams about owning a warehouse the way they dream about owning a fleet of trucks with their name painted on the side. And that's exactly why the warehouse owner is laughing all the way to the bank. Prologis, the largest industrial real estate company on the planet, doesn't move a single package. It owns the box the package sits in while it waits. As of late 2025, Prologis controlled roughly 1.3 billion square feet of logistics real estate across 20 countries, leased out to nearly 6,500 different customers, running at occupancy above 95%. When a lease came up for renewal, the net effective rent change over the life of that new lease came in near 49% in some quarters and above 66% in others, meaning tenants were routinely paying half again as much or more just to keep the exact same four walls they already had. Here's why that number is so much bigger than it sounds. E-commerce fulfillment doesn't just need warehouse space. It needs roughly 3 times more square footage per dollar of sales than a traditional retail store because online orders demand more inventory variety, more buffer stock sitting on shelves, and dedicated space to process returns that never existed in a mall. E-commerce penetration is projected to climb from 24% of retail in 2024 to nearly 29% by 2028. Every point of that growth is more square footage someone has to lease from someone. And increasingly, that someone is a company like Prologis, sitting on land next to ports and airports that can't be duplicated across the street. The trucking company owns a truck that starts depreciating the second it's driven off the lot. The broker owns a relationship that can evaporate the moment a bigger platform undercuts them on price. The warehouse landlord owns dirt and concrete in a location that physically cannot be replicated next door and charges rising rent to every single company that needs to touch that freight before it ever reaches your front door. Nobody puts a picture of a warehouse on the cover of a business magazine. It's the box nobody looks at that ends up owning the whole supply chain underneath it. So the broker schemes the spread and the landlord collects the rent. Someone still has to be underneath both of them, physically absorbing the cost of actually moving the freight from point to point. And that's where owning a logistics company stops looking like a smart investment and starts looking like a trap with a steering wheel. Here's the number that should scare anyone about to buy a fleet. According to the American Transportation Research Institute, it costs an average of $2.26 to run a single truck 1 mile in the United States. Not to profit, just to break even. Fuel, insurance, maintenance, truck payments, and the driver's wage all get baked into that figure before a single dollar of revenue shows up on the other side. Driver wages alone now eat up 43% of that per mile cost. More than fuel, more than maintenance, more than the truck payment itself. Wages have climbed roughly 68% since 2014. Insurance is up nearly 40% in the same window. Truck and trailer payments hit a record 39 cents a mile in 2024. The cost of simply owning the truck has been climbing faster than almost anyone's ability to actually charge more for using it. Now here's the twist nobody puts in the brochure. Not every mile a truck drives gets paid for. A driver who delivers a load in Atlanta doesn't automatically get handed a paying load straight back to Dallas. Sometimes that truck drives home completely empty, a deadhead mile, burning the exact same fuel, insurance, and wages for zero revenue whatsoever. Fleets routinely lose 10 to 20% of total miles this way, and every single one of those miles still shows up on the cost side of the ledger, whether a customer paid for it or not. Then there's the cost that never shows up on a spec sheet at all, your own workforce walking out the door. Large truckload fleets see driver turnover above 70% a year. Every time a seat empties, that carrier is back to recruiting, licensing, and training a replacement, while the truck itself sits idle in a lot, generating exactly zero revenue and still accruing insurance and loan payments every single day it's parked. Stack the fixed costs, the rising wages, the empty miles, the turnover, and the freight downer that hit the industry through 2024 and 2025, and the number gets genuinely brutal. The average operating margin across the entire truckload sector was negative 2.3% in 2024. Owning the trucks, the part that looks like the actual business, the part with your company name on the door, was on average a money-losing exercise. This is exactly what happened to Convoy, a digital freight matching startup that raised money at a $3.8 billion valuation, built an app that looked exactly like the future of trucking, and still shut down completely in 2023 because owning exposure to the actual physical movement of freight, even wrapped in brilliant software, couldn't outrun the economics sitting underneath it. The truck is the most visible part of a logistics company and the least profitable part of owning one. Anyway, if this is the first time you've actually seen the real numbers behind an industry that looks simple on the surface and isn't, that's genuinely the entire reason this channel exists. Hit subscribe now, because the next breakdown does exactly the same thing to a completely different business, and I don't want you to miss it. Now, if owning trucks outright is this brutal on average, does that mean nobody should ever own a truck? Not quite. There's one structure inside the asset-based world that behaves completely differently, and it's the one thing separating the carriers who survive a freight recession from the ones who don't. It's called dedicated contract trucking, and the idea is simple. Instead of chasing whatever spot market load happens to be available today, a carrier signs a multi-year contract with one large shipper, a Walmart, a Home Depot, a major manufacturer, to run the exact same lanes on a fixed schedule at a locked-in rate indefinitely. J.B. Hunt's dedicated contract services division posted operating income growth in the double digits, even in quarters where the company's spot exposed segments were shrinking, because dedicated freight isn't fighting for a price every single morning. It already has one. Compare that to J.B. Hunt's own intermodal division, trains and containers instead of trucks, which pulled in over $1 billion in quarterly revenue, but generated an operating margin closer to 8%, because it's still exposed to the same swings in shipping demand as everyone else in the spot market. Same company, same balance sheet, two completely different risk profiles sitting side by side. One division is renting out predictability. The other is still gambling on volume. Here's the pattern underneath all of it. The safest money in trucking doesn't come from being the fastest or the cheapest. It comes from removing yourself from the market entirely, locking in a price before the freight recession even starts, so it simply doesn't matter to you whether rates crash 6 months later. Predictability isn't the boring version of this business. It's the only version that survives a downturn. Here's the catch that keeps this from being the obvious answer for everyone. Big shippers don't hand out dedicated contracts to just anyone with a truck and a DOT number. They want carriers with a long safety record, enough scale to guarantee coverage every single day of the year, and enough capital to weather the first 18 months of a contract before the relationship proves itself. The dedicated model is the safest version of trucking that exists. And it's also the version that's hardest to get into, precisely because it's the one everyone in the industry already knows is safest. There's one more cost sitting underneath everything we've covered so far that most people never even think to ask about because it doesn't show up until the one day it very expensively does. What happens when the freight just disappears? Cargo theft used to mean somebody physically breaking into a trailer parked at a truck stop overnight. Increasingly, it's entirely digital. Organized criminal networks impersonate real freight brokers, forge the paperwork, and get a legitimate carrier to hand over a full truckload voluntarily. No lock-picking required, just a convincing email from a spoof domain. Strategic theft using fake credentials and fictitious pickup requests is up roughly 1,500% since 2022. The average confirmed theft now runs close to $274,000 per incident, up 36% in a single year, and total losses across the industry sit at an estimated $6.6 billion annually. More than $18 million disappearing every single day, somewhere in America, right now, while you're watching this. Here's why this matters specifically to whoever's holding the legal title. Nearly 3/4 of stolen freight is never recovered. That loss doesn't get absorbed by the broker who arranged the shipment, and it doesn't get absorbed by the landlord who stored it overnight. It lands squarely on whoever legally owned the truck and the cargo the moment it vanished. Higher premiums the following year. Tighter insurance requirements just to renew the policy at all. More money spent on GPS tracking and tamper alerts just to keep the coverage you already had. It's a cost of ownership that sits invisible on the balance sheet until the one incident that erases an entire quarter's margin in a single afternoon. The people who profit most from freight are almost always the ones who never have to physically hold it long enough to lose it. So if owning trucks outright is a coin flip on margin, dedicated contracts are the exception that actually works, and cargo theft can erase a year of profit overnight. Is there a version of owning logistics that lets a regular person put up their own capital and actually run something? There is, and it's the one hiding in plain sight behind every delivery van in your neighborhood. FedEx doesn't own most of the trucks that deliver your packages. It franchises the last mile out to independent contractors, nearly 10 million deliveries a day, run by people who bought a territory, bought their own trucks, hired their own drivers, and signed a contract with FedEx Ground. On paper, this looks like the dream version of owning a logistics company. Real listings show contractors pulling in $520,000 a year in cash flow on $2.1 million in revenue, a 24.8% margin, no rent, no sales team required, a guaranteed weekly payment from FedEx, and a protected territory where no other contractor can compete with you for the same stops. Here's what the listing doesn't show you. FedEx sets the rate per stop, not the contractor. And residential deliveries, the ones that exploded during the e-commerce boom, pay contractors roughly 40% less than business-to-business deliveries, while actually costing more fuel and more time per package, because you're weaving through a neighborhood one house at a time instead of pulling up to a single loading dock and dropping 40 boxes at once. One contractor summed it up perfectly to industry researchers. His business made $300,000 one year, $350,000 the next, and he was working twice as hard just to get there. You don't fully own a logistics business in that arrangement. You own a franchise where FedEx sets the price, FedEx sets the volume, FedEx sets the rules, and you personally absorb every rising cost that shows up in between. The brand is the asset. You're just the fulfillment layer underneath it, wearing the uniform. Ownership without pricing power isn't ownership. It's a very expensive job with a business card. And there's a reason FedEx structures the entire operation this way, instead of simply hiring drivers directly. The moment FedEx employs a driver, FedEx owns the liability that comes with that driver, benefits, overtime, workers' compensation, the legal exposure of an accident on the road. Push the trucks, the fuel, the insurance, and the employment relationship onto an independent contractor instead. And all of that risk moves off FedEx's books and onto the contractors, while FedEx keeps the brand on the side of the van, the software that routes every stop, and the pricing power to set what each delivery is worth. The contractor isn't just buying a franchise. The contractor is buying FedEx's liability priced as an opportunity. So who actually wins across all of this? Look at where the money concentrated over the last 2 years of the worst freight recession in a generation. While mid-sized brokers bled cash and carriers filed for bankruptcy by the dozen, C.H. Robinson posted an estimated $550 million in net income for 2025, an adjusted operating margin north of 31% in a single quarter, while cutting average headcount by nearly 13% at the same time. Not by owning more trucks, by automating the matching process itself, running over 3 million shipping decisions a year through AI systems that used to require a human on a phone call. Meanwhile, RXO, a newer, smaller competitor chasing the exact same freight, saw its gross margin compress from 19% down to 17.8% and posted a $63 million loss through the same stretch. Same industry, same freight recession, wildly different outcomes, because one company owned the data layer at massive scale and the other was still fighting for basic volume to survive the year. This is the part that actually matters if you're thinking about this industry from the outside. Scale in logistics doesn't just mean more trucks or more square footage. It means more shipments flowing through your system, which means better data on which lanes are mispriced, which carriers are desperate for a load today, and which spreads are safe to take without losing the customer to a competitor. The company processing the most transactions sees the market first, and every smaller player underneath them is just reacting to prices that company already helped set an hour earlier. Amazon took this idea to its logical extreme. For years, Amazon paid UPS and FedEx to deliver its packages, which meant every dollar of last-mile margin flowed to somebody else's balance sheet. So Amazon built its own delivery network instead. Thousands of independent delivery service partners running Amazon-branded vans, an in-house air cargo fleet, and warehouse space it now owns outright rather than leases. FedEx eventually walked away from handling Amazon's ground packages altogether because Amazon had quietly become large enough to stop being FedEx's customer and start being its competitor. Amazon didn't just use the network other companies built. It noticed how much margin that network was keeping and built its own version to keep that margin for itself. That's the entire industry playing out inside one company. Amazon started in the physical layer, the warehouses, the trucks, and used sheer volume to climb into the information and infrastructure layer above it, the same layers C.H. Robinson and Prologis already occupied. Once you own enough of the physical grind, you get to stop paying rent to the people above you and start collecting it instead. Here's the whole industry in one sentence. The freight moves through trucks, but the profit moves through information, and the closer you sit to that information, the less exposure you need to the physical grind underneath it. That's the real architecture of a logistics company. The visible layer, the trucks, the drivers, the warehouses full of pallets, is the part that absorbs almost all the risk and keeps almost none of the margin. The invisible layer, the broker spread, the landlord's rent roll, the platform's data, the brand's pricing power, the locked-in contract that removes you from the market entirely, is where the actual business lives. Buy a truck, and you've bought a job with brutal hours and a coin flip margin. Buy the network, sitting on top of 10,000 trucks you'll never personally own, and you bought the business. The freight was never the product. The gap was. If you take one thing away from this video, take this. Whenever you're evaluating any business that looks like it revolves around a physical asset, a truck, a building, a machine, ask who actually captures the price, not who touches the product. The person driving the truck rarely sets the price of the ride. The person who owns the data that decided what that ride was worth almost always does. Which raises an uncomfortable question if you've been following this channel for a while. Because there's another industry running the exact same playbook, except instead of trucks and warehouses, the physical assets are steel towers scattered across every city on Earth. And instead of a broker taking a spread, there's a landlord collecting rent from every phone carrier that needs to reach your neighborhood. That's next, the economics of owning a cell tower, and why the company that owns the tower barely cares which carrier is renting space on it.